How's it going, everybody, and welcome back to the Real FI podcast. I'm your host, Patrick McGrath, with my co-host, James Rippion, rocking the hat today. How's it going, James?
It's going well, Patrick. It's a good day today, and we've got a fantastic guest with us. We've got Doug Peacock. Doug Peacock is going to be sharing an immense amount of knowledge and wealth building tips, and let us know what he's doing in his business to help people on their path to financial freedom. So with that, let's get started. Doug, why don't you introduce yourself and just kind of tell our listeners what you've got going on in your business?
Yeah, it's hilarious because nobody ever knows who Doug Peacock is. I literally coached football for 38 years, and none of them know my name's Doug. It's always Coach Peacock. That. So when I say Doug Peacock, it sounds really strange, but no. So I mean, I was a high school football coach and absolutely loved it, and eventually the body got tired, and couldn't do a lot of that anymore to the level that I wanted to do it. So realized I wasn't done coaching, but I certainly had to change fields. Had always been a big out of debt guy, wanted to get people out of debt. And then I met a man named Nelson Nash and got me on a concept called infinite banking. And the first time I heard it, I thought, y'all going to jail. I mean, these guys just want orange jumpsuits, man. That's all there was to it. But then I found out they'd been doing it a couple hundred years. Then they had my attention. So I immediately learned that you could use $1 in two places at the same time. So I literally saw a chance for all of my former players to get out of student loan debt. And bang, 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 it took off. And I'm still trying to get out of teaching, and
Right.
and we're doing a lot of these policies to get them out of debt. Yeah.
So let's tackle this and sort of the motivation, and then we'll get into infinite banking. So
Sure.
You said you're working with your students and your the players that you're coaching, and you're seeing this student debt problem. Let's talk about what you're seeing with that and how that was impacting your mentees' ability to generate wealth and start a career for themselves.
Well, there's over $1.7 trillion of student loan debt in the United States today.
That's too much.
You think? I mean, we have the government garnishing Social Security checks to pay student loan payments. Think about that. This is absurdity. So anyway, I learned real quick that I could put money into a policy, specialized policy, and we'll talk about that in a minute. But they can use that money to pay off student loan, and it still grows. So they could kill the student loan and save for the house at the same time. Now all of a sudden, all this makes really, really good sense. And our average numbers were we literally had kids out of debt. Now you got to understand, some of them are in debt a whole bunch, some of them are in debt just a little, but the concept was we were literally had them out of debt in 5 years, and they had about $50,000 sitting in a cash value ready to use for whatever they wanted to. That's not a bad place to be.
No, not at all. Not at all.
And the word got out, and all my players said, hey, you got student loan, talk to coach. And that's how it all started. I'd never intended to do any of this. I got zero training for business. It's just helping people get what they want. And I found out that you can make a business out of that. So,
well, it sounds like you were offering value, trying to help, and your business just kind of built around that. And I think that's an important lesson for people to grasp is, don't look for the ways to make money, look for the ways to provide value. And student loan debt, $1.7 trillion, that's a lot of value to be provided. And so far that you can get rid of that debt for students.
I will, it's not, I didn't do this to make money. I didn't coach to make money. Okay. By the way these things work, I get paid, 50, 60, 70% less than the average guy that's out here selling an insurance policy. That's by design, by the way. Okay. Coaching, you guys already know, coaching doesn't pay diddly squat. So it's, I didn't do it for money. I did it because I was a country kid and somebody gave me a chance to play college football, and the school paid for it. And I'm going, yeehaw, is this a great country or what? Had no idea what that was all about. And then decided that, I really wasn't good enough to continue that career. So I had to do something else. So I ended up coaching and loved it. Absolutely loved it. But the same thing is true here. People just don't understand how their money's working. And we're going to do stuff just because everybody else does it. All right. How's that 529 working out for you now? We're buying stock market products through a government program. I mean, this is double disaster. Okay. So,
yeah. And you can agree. I mean,
if you want to get out of that, I got to wait. If you like that, have at it. I'm not your guy, and I'm okay with that.
Yeah. I mean, well, I also think, with the government subsidizing and backing these student loans, that is what has created this entire debt crisis, because colleges started increasing tuitions over and over and over again because they had these guaranteed government-backed loans. And they created, because at first it was the American dream to buy a house. And then once they had loaned all the money out for houses, they're looking for the next thing. And it was, now everybody needs a college degree to get a good job. And that was the next thing to start loaning out trillions of dollars. Now here we are.
Well,
so go ahead,
I was going to say it's the moral hazard that's created, because with the student loans, this is one of those types of debts that are non-dischargeable in bankruptcy. So when you have nothing left, you're going to have even less than that if you have a whole bunch of government sponsored and backed student loan debt, because you can't wipe that slate clean, just like you can't wipe taxes you owe clean either. So this is just one of those things that is
like Patrick was saying, though, the colleges couldn't lose. They couldn't lose. Oh, we'll just give you a bigger loan.
Exactly. Hey, let's put your housing on there too, and your food, and your books.
And we'll refinance it all into one lower rate for you.
Yeah. Well, that's another concept. And
I'd really like to ask for everyone out there, because I know there's been a ton of stuff about this all over TikTok and Instagram, and people having their 30-second, 1-minute reels about infinite banking and everything. But if you could explain to us what is infinite banking?
Don't get me wrong, I love the term because I love Nelson Nash. Okay, now he took his final graduation. It'll be 2 Marches ago this upcoming March. But the infinite part is this can be used anywhere, and we'll talk about that in a moment. But infinite banking, guys, all we're doing is creating a warehouse for your wealth. You've got to store your wealth somewhere. Now, wherever you decide to store it depends on how it's treated, with interest, with return, with taxes, with fees, with commissions. All of those things are in play now. So you literally want to sit back and start thinking about, what do I want my money to do? Yeah, I got it. Grow. Everybody wants it to. Why do you want your money to grow? What are you going to do with it? Well, and so now that's the next step. What assets are you going to buy? Because if you're just going to go out here and, buy something, that's not what this is for. You're not going to like me. Okay. And then sometimes a coach has to get on you a little bit, and I will do that, because I want you to get an asset that's going to produce more money for you in the future. I don't care what it is. I've literally got people using their house, if you will, to buy cattle or horses or top end antique cars. I mean, I got to pay $250,000 for a car. I'm going, you did what? And he says, yeah, but it's worth about 700. I'm going, oh, okay. I mean, that's not what I'm going to invest in because I don't understand that.
Mm-hmm.
And I just, I think that's everybody. I think everybody has to have their own investor DNA, what you want to go buy an asset in. But the truth is, I want you to go buy an asset. I don't want you to go buy something that's going to, a nice car that's going to depreciate as soon as you drive it off the car. And there's nothing wrong with nice cars, okay? But my point is that car's not going to make you any money.
Exactly. And I think a lot of the people that are listening to our podcast specifically are, real estate investors, business owners, cryptocurrency investors, Bitcoin, different things like that. Those are the type of people that are our listeners. And you're saying that they're able to purchase these assets with funds that they put inside of this. Is it an insurance policy? Like
it is.
like
it is.
explain a little bit about what it actually is.
Sure. The actual warehouse that I use is a very, very specific and unique whole life policy. Now, you gotta understand, I was a huge Dave Ramsey fan. So I mean, I am fighting this. I have got a learning curve out of the world on this because what idiot puts money in a whole life policy?
Exactly. I had one when I was younger and I didn't understand it and cashed it out. So,
and I will tell you, it's probably the best thing you ever did because it's probably a traditional, conventional whole life policy. Those policies have no cash value for 3 to 5 years in them. Who's got time to park money for 3 to 5 years and hopefully, hope that one day, someday that sucker kicks in, and in 30 years, I may have enough money and I may not. So my point is, I want a very specific whole life policy. It has to be designed for minimum death benefit, but maximum cash value. Exactly the opposite of what's being sold by everybody else on the planet.
Because they get a very large commission on those whole life
death
policies.
Benefits, on those death benefits. Okay.
Exactly. So what is this policy called?
Oh, it's just a whole life policy, but the design of it is the key. Okay. You have to have the right coach or you can't get that money. So when I tell you I build this thing for cash value, depending on what you want to do with your money, and this is how I started was with the student loan. So what they're going to want to do is they want that money very, very quickly. So in 30 days, they're going to have money that they can pull out of that warehouse to go kill a student loan. So they wipe that student loan off, but now then the payment that they were paying to the student loan comes back to the insurance company. Why do I want to do that? Because now my money is going back and forth, and I'm reusing that dollar over and over and over again. And all I'm doing is collateralizing it with the insurance company. All right.
Okay.
So now then I get to borrow it again, in 3 months when I have, because everybody comes out, and truthfully, one of the worst things you can do is consolidate them. Okay. I would much prefer you have 18 of them. We're going to knock them suckers off one at a time.
And you're talking about loans or debt or something
student
like that?
Loans. Yeah.
Okay.
And that's how I started. It could be debts. I mean, I've had people, who never met a bill they didn't like, they got, why would you have 3 snowmobiles in Indiana? I don't understand that. Yeah. You get to use them once every 10 years, now this may be the year. Okay. But my point is any debt works, and it's for you to figure out what you want that money to do.
So
to me,
I was going to say, let's talk about how the policy is structured and works a little bit. So you've got the people that you're working with, they're putting money into their policy and they're building up the principal basis in there. How are they going into that policy to pay off debts? Like what's the functioning process there, and correct me if I'm wrong, but doesn't the whole life policy generate interest on itself to begin with?
Absolutely. And I'm going to use that. So here's the plan. I'm going to throw a bunch of money in this. Okay. And we'll talk again. There's a lot of little steps here because this is so different from what everybody's been taught. I would never do that. Well, what if you were making money on it the whole time? Oh, and paying off your student loan. Okay, so now you're going to sit down and at least listen to me. So the bottom line is, yes, they're going to pay a premium. There's a part of that that goes to the cost of insurance, the cost, administrative costs and stuff like it, and you're not going to get that back for a while. But the truth is, somewhere around 7 years, you're going to make more money in that policy than you put in. Think about that, because now who's paying who now? Time out. I put $10,000 in, but I made $15,000 in that year because it's like you said, it's growing. It's not only growing with interest, it's also growing with dividends. Now, dividends are a little special, okay? They're not guaranteed. The interest is. Okay. Every company is a little bit different, and I don't want to get into the weeds with that, but they do earn interest, just like you said.
Okay. So I was thinking of dividends and interest almost being the same thing, but you're saying that's different.
They are not. They are not. That's correct. Now, are they treated the same once they hit your cash value? Yes, exactly. So the truth is, dividends are not guaranteed. Okay. And that's why we have to use special companies. You can't just go to any company and get this, because if it's a stock company, who do dividends have to go to? Stockholders.
Shareholders, yeah.
Right? So I've got to go to a mutual company where there are no stockholders. So now all the dividends, which are nothing more than excess profits, okay? Where do those excess profits have to go to now? Oh, that would be me, a policy owner. So I am literally, through a mutual company, I am literally part of the ownership of that insurance company. Now, it's a tiny sliver. Don't think, I'm making gazillions of dollars. I'm not. It's just a tiny sliver. But I still get my dividend. Once it hits my cash value, it cannot be withcalled. It cannot be reduced. It's just like cash value. It's guaranteed to grow more next year than it did this year. And it's available to borrow in 30 days. Oh, shucks.
Very nice. So
Yeah.
what is the typical, what is the typical or average, interest rate that we're talking about here for these guaranteed? So 2-3%?
5.
Around 5%. Okay.
Now, some are small, some are lower, some are higher, some are all right. But even in the lowest interest rate in the history of the planet, guys, for the last few years, these mutual life insurance companies are still standing strong. Well, it's almost like they've been through it before. Oh yeah, they did. Spanish flu in 1913. All these things back, man. They've been through these. There's the strongest companies on this planet, and I get to own some of them.
And I know that this is, this type of infinite banking, these whole life policies, were and are used by a lot of the wealthiest individuals in the world. Like, let's talk about Standard Oil and Gas, the Rockefellers. A lot of different people have utilized these plans for their tax benefits, for reinvesting their money and all of that. And I'd like to get an example of how someone like myself, could utilize this. So you're basically saying that, I could put, let's say, $100,000 in cash into one of these plans right away.
Yep.
Like if I wanted to dump $100,000, for instance, I get the plan, and you're saying within 30 days, I now have access to that money, and I can go and take 50,000 out and put it on a down payment for a rental property if I wanted to, and that other 50,000 would still be collecting interest. But now I'm just required to pay the premium. What's a premium kind of look like on something like that?
The premium was your 100,000. Okay. There are people who will literally do this And a lot of them are real estate people. Single premiums. Now then, I am going to correct you a little bit, okay? But because if I put $100,000 in there, there's going to be some fees and cost of insurance and stuff come out the first year. So you may not get all that money up front. Okay.
Okay.
But if I'm willing to trade 20, 30% of my money right now for access to 70% of my money, is that worth it? And that's different for everybody. Okay. Particularly guys who move a lot of real estate and do a lot of big numbers. But you got to remember, let's use your numbers that you talked about. I put 100 in, 30 days later, I take 50 out. Okay. What is still growing? Okay. Day 31. What is still growing in the insurance policy? 50 or 100? And that's the key. It's 100, guys, because I didn't borrow my money. I borrowed the insurance company's money. Okay. Now there's a lesson here too, because you got to understand that's going to earn uninterrupted compound interest that you're getting nowhere else. Everybody says you are, but you're not getting it anywhere else because volatility, fees, you use the money to buy something, whatever. You interrupted that compound interest. I'm not here. What would a warehouse of money do if it never went backwards?
I think that's so incredible, because this is a compound wealth building vehicle like no other. It's not something that I've taken advantage of personally, but like Patrick said, I've read again and again how the wealthy are taking advantage of systems like this and making their money work for themselves twice. Once in the policy, earning whatever percentage plus dividends, and then again when they're taking that money back out to buy other investments. And there's this complete arbitrage opportunity that's going on. So I do have a question for you though. When you pull that money out of your policy and you're effectively taking a loan against it,
you
are you paying interest?
You are
to yourself basically.
A lot of people like to sell that where you can charge yourself interest, and that's truly not what happens. So I want to be clear. You're going to borrow that money. And yes, there's going to be interest involved, but it's going to be simple interest. Now, I will tell you, as a PE major and a high school coach, I flunked this lesson big time. Okay. And I'm going to use numbers that I know. Okay. But numbers are numbers. Okay. So if I took $30,000 because my wife wanted a car, and it's a nice car, all right. Now you can tell how old this is because you don't get those anymore.
A pre-pandemic car.
Yeah, very pre-pandemic, by the way. But anyway, I can take that $30,000, go borrow it. Cost me $566 a month at 5% for 5 years. You do that math out, okay? Or I turn around and take $30,000 invested at 5% for 5 years with compound interest. So I'm paying simple interest or amortized interest over here, and I'm earning compound interest over here. And now you get the arbitrage that you were talking about. All of a sudden, those numbers have to, I know I heard that in math class. Those numbers have to be the same, and they're not. And in real estate, you know that they're not, because you do that all the time. Money's made on the buy, right? And then, and that's where that arbitrage comes from. And there's literally $4,200 difference in that example that I gave you. Okay. So now it doesn't become a question of whether or not I want to do this. It's how many times can I do this? Because I make $4,200 and the wife gets a new car, and man, happy life, happy wife, we're cooking. So and now add zeros and now you've got real estate. But the point is, guys, you cannot stop that thing from growing with uninterrupted compound interest. The only way to stop it is to kill the policy.
So when I take a loan out, when I take a loan out to buy real estate, so does this loan does the real estate have to be tied into the policy? Like, is it as a, like a collateral or anything like that for the payback? Is it being held? Because you're saying it's kind of like a warehouse of your investments. So I'm just wondering, like, does the real estate and the policy have to be tied together at all? Does it really matter what you utilize this money for?
Okay. There's one banker in this. Okay. And it's you. Do not tie that policy to your property. Got
Okay.
me?
Mm-hmm.
Whatever you're doing. Because guess who controls the payback on this policy loan?
Is us.
One banker.
Yeah, it wouldn't make sense that you
You.
default on your own loan.
No,
I guess.
don't do
Yeah,
that. Now,
true.
don't do that. You want to go run to the insurance company for permission to leverage your property or to refi or to take a cash out withdrawal or no, shucks, no. I'm going to the one banker. Oh, by the way, that would be you.
So, the way my brain is working on this conceptually, and especially from a real estate perspective, if you were to start off your wealth building career, building up this policy, building up a really big nest egg in here, you're going to be earning, your interest plus your dividends. And when you get to a certain point, you might be able to leverage a policy like this to buy real estate with cash. Okay, buy that property and then maybe refinance into a longer term conventional note with a commercial lender or something like that, and recycle this money all over again. So especially for all the real estate investors listening, this sounds like it could be a really, really fruitful addition to any portfolio.
And people are doing it every day. So not only people, not only rich people, there's a term out there called BOLI, BOLI. It's called bank-owned life insurance. In 2019, 4 banks borrowed $54 billion worth of cash value life insurance. Why? All the things you just talked about, guaranteed growth. It's going to grow. You can't stop. Oh, and they have access to it. In fact, even more access than you and I do. Okay, because they're special policies. But the bottom line is, now I've got 54 billion sitting here. Somebody walks in with a $200 million real estate deal. I don't even have to involve anybody other bank. I can just say, okay, yes, here's the terms of the agreement because I own the policy. I take a policy loan, give him the 200 million, put a lien against, all that kind of stuff. And now all of a sudden they're making money. And guys, life insurance is a tier 1 asset to a bank. Why? That's one of the safest things that they can do. They're not going to lend you, the money that somebody puts in there. Okay. I mean, they may default,
Exactly.
And now I get hurt. Guess what?
Now,
they can't lose this.
Is the money that you're funding this with, is that tax deferred? So if I put 100,000 into a policy like this, is that 100,000 not taxed from my taxable income, or how can I utilize this when it comes to my taxes?
There are literally 6 internal revenue codes that protect what we do. Now you'll understand why every congressman owns these. When Mitt Romney ran for president, he was in the 15% tax bracket, yet he lives the life of a billionaire. Guess where the money was coming from? I will go as far as just tell you that it not only grows tax deferred, but it's available tax free. And guys, if you get the right coach, I'll teach you how to use this tax exempt. There's not even a line on a tax form to put this number. That's why it's so valuable. Okay. Compare that, because after I get done paying off my student loans and buying horses and buying cows or whatever I buy, there's going to come a day when I just want to say, okay, I'm done. I quit. I want to go, I want to go fishing or golfing or whatever I want to do every day. Now, what's this going to do? Well, it's still growing. It is still, I can't stop it from growing. So now all of a sudden I can take money out of there, tax exempt. You want your retirement check to be tax exempt, not have anything to do with your Social Security, not have any ramifications on your Medicare. Not guys, there's no comparison between that and what 90% of America has. You don't even know what your 401k is going to be worth the day you need it because of volatility and because of the taxes. And nobody knows that. And if they tell you they do, they're blowing smoke.
Well, and this is a great source for liquidity too, tax-free, because people, they often think like I can go to my house, value in the equity, pull some money out in the refinance or a HELOC, and go use that to do whatever I want, whether it's buying a fancy car that you don't need or an investment property that you probably should buy. But the difference is, you don't have that intermediary with this infinite banking concept that you would with a HELOC or a refinance. Like, you don't have to go to the bank and ask for permission. You're not gonna run a credit report on yourself and deny yourself out of fear of not paying back the loan you're going to take against yourself. So
where were you guys in 2008?
Too young to
don't
I
answer
was
that.
right out of high school.
Because you guys are young puppies, man. I got this. But the bottom line is, I'm a HELOC fan. I'm a line of credit fan. I'm not telling you not to go borrow money. I think there's good reasons to borrow money. Okay. I just want to make sure you're in control of it. And when you step into the HELOC world, you're not in control of it. There were businesses that got ruined. I mean, they're gone. They're not even there anymore because when what's the first thing to take a hit? What's the first thing to go under when the economy crashes?
Small businesses,
access to money,
capital,
right?
Access to capital.
It's gone. They're not. I mean, there's some really, really rich people couldn't get loans. I guarantee you, Coach Peacock wasn't going to get one.
Well,
So now
a
all
lot
of a sudden,
people,
well, all I got to do is 1-800, or now, I mean, you got to understand the companies we use, guys, they have paid dividends for the last, fact, I just read one yesterday, 117 years in a row. They're not guaranteed, but I'm going to tell you, I'm going to take that track record.
Yeah, I don't know anybody with a longer track record than that.
Do that. Do the math. That means somebody got a dividend check in the Great Depression.
That's right.
How weird were you? I mean, one of my mentors talks about don't be average. Shucks, no, don't be average. How weird were you? That was not average. I'm just telling you, you've got to control the money. Okay? I don't care what you do with it. I really don't. I don't care what. I hope you buy an asset, and or you're going to learn that when it doesn't return money to you, you got to save more money. You got to bank more capital, right? And that's totally, the amount that I borrow is totally dependent upon the money that I put in there. Got it? Now then,
I do.
Eventually,
here's one of the
interest
things
is going
that I'm
to pay
thinking.
more. I'm going to get paid more than I put in. Yeehaw!
That is right. Well, here's one of the things that I'm thinking is that a lot of people don't know this, but
absolutely.
What I was going to say is your home equity lines of credit, your HELOCs, the equity that you have in there, those line of credits can be taken away during a credit crunch if they're not utilized. So if you have $150,000 or $200,000 with a HELOC that you just have over there for safekeeping, during a credit crunch and during a recession, the banks can actually decrease that or take that away from you. So if you're locked into a 5% interest rate term, I'm here thinking in my head, you could pull out that equity that you have on that HELOC, throw that into one of these, whole life policies that's going to be generating, that 3 to 5% interest, making those payments. You're making those payments. You still have access to the funds like a home equity line of credit, but the bank can't take that money back from you, and it's building upon itself, almost covering the payments that would be, because they're interest only for 10 years. So it really sounds interesting to me, but I did want to hit home on that because a lot, like you said, we're headed into a downturn. A lot of
Yeah.
people have been trying to get loans and pull out equity in their properties to have access to money, and this is an
Yeah.
alternative that can't be taken away. So for
Go
someone that
study, go
would,
study 2008. That's exactly what happened.
that's why I'm trying to, for
Yeah.
us younger guys, that didn't go through that. That's what I've read. And, we've taken out HELOCs recently to have access to capital for this upcoming downturn. And I'm trying to juggle, whether we deposit all that money into our account so they can't take the access away, or figure out something to do with it if a property doesn't come up sooner or later. So for someone that wants to take advantage of something like this, that doesn't have a ton of money, like what's the starting amount? Are we talking, you need at least 10,000, 20,000 to put into one of these policies to really start making it work? Like, break that down for us a little bit on how it all works to
Sure.
do something.
I tell you, I treat them very individually. Now then, I will tell you, I don't have a minimum. Some of these guys that are out here selling these things, and I don't want to sell it. I want you to understand what you're using it for. And when you understand the why behind why you're doing this, now all of a sudden it makes sense to you. All right. And it's not, I don't have an insurance bill. I've got a chance to capitalize the warehouse. Okay. Oh, no, by the way, you can own more than one. Just a thought, because I got 5 grandkids. What do you think the insurance costs are on a 14-day-old child? What's the insurance cost on that child? Tiny, 7 cents. I don't know. I'm just making up numbers there. But my point is, they work exactly like HELOCs. The only difference is the bank does not control access to the money. You do. And it's literally 1-800. No one can step in front of you. If the money's in the policy, the insurance company has to let you borrow it.
Okay.
And are the premiums tax deductible?
They could be, depending on who pays for them, but I'm not sure you want to do that. Okay. My general rule of thumb is to make sure everybody buys one individually first. I want to pay the taxes today, because what I do from that point on, it's going to disappear off the radar screen of the IRS. That money's never going to exist anymore. I don't care how many properties I buy with it. What a concept. I just changed your life. If you got that right there, oh my gosh. But so my point back to the premium, I've got guys who make a lot of money, and they're putting $10,000 a month into one of these things. Okay. Obviously, big earners. Okay. I've got single moms doing $157 a month. And I will argue that her $157 is far more important than his 10 grand, because she needs that money. Because that baby gets sick, or that baby, she needs $3,000. Where does the typical single mom come up with that money?
Credit cards.
She doesn't. She's fighting, or she goes and gets a credit card, and now she's in a trap she can never get out of. So my point is, I don't think that the concept. I don't care whether you're using 157 or 10,000.
And I'm trying to understand, what happens when I take out this 50,000. We're going to stay with that example. I take out this 50,000. I use it for a down payment on a property. I refinance the property, get my 50,000 back. That's tax free, because I'm refinancing, getting another loan to put it back. Now, but what happens if I sell the property and now I have a delta? Now I have a taxable event, and I used the money from the life insurance policy to put down on the property. So I got to pay it back. So I'm just trying to figure out how that money kind of works to where I continually use it tax free.
I'm
The
leaning
first thing
towards
I'm
that
going to tell. Go ahead,
probably being
James.
taxable, but I'm curious to hear what Doug says.
Well, first thing I'm going to tell you, when you get your $50,000 back on the property, the very originally, I'm going to tell you to put that 50,000 back in the policy and repay your loan.
Well, that's what I'm saying. But
Why?
is that
Because now
50,000
that's
taxable?
usable again. It is not taxable. Everything we do is tax exempt. Now
Right.
then, when you sell that property, now you're going to have to go find you a tax person and a real estate guy, because I don't know that. I know there's 1031 exchanges. I know there's 10 for what I do, there's 1035 exchanges. Same type of rules. It's just because if you bought the wrong cash value policy, I can take the cash value in that policy and roll it into a good policy that'll allow you to bank with it.
And that's
and it's tax free.
Okay, so that is really cool. If you wanted to swap in and out of policies, they've got a tax exempt 1031 equivalent process for that. That's pretty cool.
It's exactly the same. It's just with a different piece of property.
Okay.
And the bottom line is what we do is an asset, guys. These are assets.
I think my mind is still thinking of it kind of like a trust. You know what I mean? Where you have to buy the assets inside of the policy. But it doesn't sound like that at all.
You can. Okay. So I will tell you what I ran across this week. This NIL stuff with college athletes, the name, the name, image, and likeness, right? Well, some of these guys are 20 years old and they're getting $1 million. Well, why not put the million or even half of it into a policy? Now, the problem is the policy itself is limited by how much it can take. But that's different for everybody based on your age, your health status, male or female. Guys do stupid stuff, women don't. So all of that changes for every human being. So that amount is different, and it's called a modified endowment contract, or MEC. Okay. So when you MEC a policy, it becomes taxable. So now it's not the end of the world, okay? Because you do have a basis in there, and you guys understand the basis real well, right? But the bottom line is, to the average guy, I don't want to do that. But there's also spendthrift trust to go another level up, if you will, that make that even tax exempt, tax free. So I can do that. And yes, we do that, but those guys are rare. Okay. But that's so far from where I started.
Yeah.
I had guys that were paying $500 a month into an insurance policy, and people thought they were absolutely nuts. And then they were out of student loan debt in 3 years with 50 grand sitting there. Wait a minute, you did what? Well, now all of a sudden, hey, talk to coach, and it just took off with me. And I was very unprepared. I got introduced into these daggum things called quarterly taxes. I had no idea what those were as a teacher.
Yeah. Well, I think this sounds like a great strategy for someone that is in debt, whether it's student loan debt, credit card debt, anything, or someone that also is wanting to get into real estate investing, wanting to start a business, and put some money away over the next 1, 2, 3 years and start saving up, so then they can borrow against it to get into their first rental property or start their business or whatever, and start doing that now, with a couple $100 a month. And it's going into a policy that you always have access to, but it's not in a bank account where you're more likely to spend frivolously on, as a way to kind of save up for those larger purchases. James, what do you think about that?
I agree 100%. And I think, when it comes to these kind of policies, and this is kind of how my mindset has been with it, it's always been something that I think like, oh, I'll do that when I get older. Like that's a mature investor thing. Like that's something I should just do when I'm more sophisticated, when I have more income, when I have more money. But You know, as simple as the, age-old investment policy of theory of, start when you're young. Like, this is one of those things that's going to benefit you way more over the years, the earlier you start getting into it. So Coach Peacock, I want to ask you, when you're talking to your students, how are you convincing them that now's the best time to do it and to not delay or not wait to get one of these policies?
If they played for me, I talk to them entirely different than I talk to you. Because we have a relationship. All right. I literally say, okay, here's what you got. Here's what you could have. It's your choice, but don't be stupid. All right. And I had a guy tell me, you can't do that. Yeah, I said, too late. It's,
Exactly.
Now then, but I do want people to understand why they're doing it. So if you take the old question, do you want $1 million today or do you want a penny doubled every day for 30 days?
Penny.
Right? Because it's $5.3 million. But it doesn't really make a lot of money till the end, correct? And I got it. Everybody wants to knock on compound interest because it takes so long to happen. Okay. Well, yes and no. What do I do to get them to start today? What if I waited 5 years? What if instead of 5.3 million, and now I'm going to take a guess at a number because I don't know it off the top of my head, but let's say it's $267,000. Well, that's not a small sum of money. I got that, but it's not on the same planet as 5.3 mil. So, think about this. Guys, my grandkids' policies will be 20 years old before they ever get them. How efficient are they at 20 years? Very. All right. Very. Now the problem is I just didn't put enough money into them. But you can't go buy that 20 years. You can't buy that. And I will tell you, everything I do is a crock pot. It's not a microwave. If you're in here to make money in 2 to 3 years, that's not going to happen. Now, is it there to use? Absolutely. It will be there in 30 days. But I want you to take a very, very long outlook on this thing. In fact, I will tell you at least 3 generations. You go study the Navajo Indians, they were 7 generations. Guys, they had this figured out. How do you even do that in a teepee? I don't know. But anyway.
Well, you bring a great point up because I just had my first son born. He's 5 months old now. And, a lot of people give you grief about starting now to invest for college education and stuff. And then you get pigeonholed into the 529. But, nobody knows what the future of a child is going to be 20 years from now. Maybe they don't want to go to college. Maybe they want to be a tradesman and start some sort of contracting business or do something artistic or whatever. Or maybe they just don't want to go to school. Maybe they just want to start a business. Then you've got that 529 account that you're pigeonholed into, and you don't have the flexibility to use be versatile with.
Please understand, with a 529, somebody's going to college.
Yeah, exactly.
Right? It could be you. All right. But yes, that's exactly right. Why? Because we're right back to control again. You don't control that.
Yeah.
Why would you do that? Why not have fun sitting there that if they wanted to be I had a running back for me, wonderful kid, was never going to play in college because he was too small and didn't want to go to college. But yet today he's teaching plumbing through one of the schools here, the colleges here, the community colleges, and owns his own plumbing business. Mm-hmm. All right. Making money that half of his other classmates never even thought about making because he's a plumber. Right. And I'm not downgrading any occupation. I was a football coach. Come on. All right. I mean, if a football coach can understand this, I promise you can.
Well, I'm overly educated personally. I'm a lawyer by training. So I've been indoctrinated to think that, more education equals happiness, dollars, whatever. But it's kind of funny. Once I started practicing law, I saw that narrative flip completely upside down, because it's those plumbers, those drywall contractors, the HVAC techs who start those businesses after they've learned the trade. And who are they hiring? I now literally work for them as the attorney. And I'm like, this is totally backwards. And I had this, perceived 100% wrong getting into this business. And, of course, you can make good money as an attorney and people enjoy that work, sure. And I enjoyed my time as an attorney. But, I saw the entrepreneurs and what they were doing, the happiness they had building their business and owning it. And just like we're talking about these whole life insurance policies, owning your asset, there's always an alternative. So I just think this is just one product that fits wonderfully into an investor's, entrepreneurs, business owners, person's versatility in growing their financial independence.
Love it. Absolutely. Do what you love. Win first, then play. Right?
Exactly.
Win first, then play. Nelson Nash owned 49 of these, by the way.
And I was going to ask what so what's the purpose of the multiple policies? Obviously they all grow, but like I think what you said is there's a balance that they can only get to. So
not a balance. You can only there's called a 7-year MEC test, and I don't want to get real deep into this, but they're limited by the amount of money you can put into them. Okay. Here's the crazy part. It's not limited by the insurance company. It's limited by the IRS.
for each policy. So then you can spread that out. You can tap out one policy, go and open up another policy.
Yes, sir.
What does that look like? I'm sure there's a range, but now I'm just curious. Like what kind of what's the range of this limitation for how much you could put into a policy?
Well, it all depends. I mean, for a grandchild, it's not very much. I mean, you go putting $25,000 a year into that thing and you already met the policy. Okay. But yet any 25-year-old could do that. Okay. Now, the older you get, the less insurance they're going to sell you because you're closer to checking out of here. Okay. So that number comes down because of that. But every number is different, or every policy is different and has a different number. But you will know that number. And, the neat part about it is the companies that I use have an entire unit built to make sure you don't cross that line. Okay.
Exactly.
And I truly, when I first started, I did not understand all of that. I didn't have all the answers, but I saw it working better and faster than I ever thought it could. And I'm going, oh my gosh, I got something. So I was not only paying back the bill that I was paying off, I was adding 10%. Okay. Thinking I was getting the 10%. That's not true. The insurance company was making the 10%. Now, eventually it probably came back to me in the dividend. At this point, I promise you it came back to me in the dividend. All right. Because I'm making far more money in dividend payments, than my premium. And
yeah, and I think our listeners just need to understand the reason that we're even bringing you on and having this conversation is to give you guys different ways to build your wealth and different options that you can look at, because you need to have different buckets. Everybody needs to have different buckets,
Yep.
Of their retirement foundation, their business foundation, their wealth foundation. And it sounds like this is another perfect thing to just add to that initially. But you can also use it to invest in your other things. And that's what's really got me interested in. I've been interested in something like this for about the last 2 years, but I just never had the ability to sit down with someone like yourself and really ask these questions and get a better understanding of it. Because like you said, we're just programmed to not make sense of this, to not make it make sense in our brains on how it works, why it works. And all of that. But there is a ton of people out there utilizing, this strategy to build wealth, to live off of the dividends, off the interest, and pull out that money tax-free, lower their taxable income on their other side of things, and enjoy life to the fullest. So, I mean, I think it's really fantastic.
It's
The
been going
information.
on forever, guys. J.C. Penney used this in the Great Depression to keep his stores open. Now, I'm not sure J.C. Penney would do that today because he took policy loans to pay his workers, his employees.
Mhm.
I'm not sure they would do that today. Walt Disney borrowed money from his own personal policies to start Disneyland, not Disney World, Disneyland.
So,
You know?
Doug, I know our listeners are going to be a little curious. Like, let's talk about you a little bit. And
Sure.
what are Doug's
Well,
goals with your business, and
well,
and how do you see kind of just growing your opportunity to work with more clients?
I I didn't understand any of this when I started. I was a traditional guy. I had a 403B, which is a teacher's 401k. Okay. Same tax law, different jobs. But I sat down with my asset under management guy and said, okay, great. Here's what this is going to look like. And there's this expanding red sash across my paper. Now it's really pretty, but I mean, it just draws your eyes. So I said, okay, what is that? And he says, that's the money you're short. I'm going, excuse me? This is, we should have been having this conversation 5 years ago. I'm out of this classroom in 60 days. And that's when I decided I'm going to go to war on this guy. And I did, and I learned, and that was almost 6 years ago. So what am I trying to do? I just want to find people who are as frustrated with money as I was. Because the first time I sat with him, oh, this is so complicated. You'll never understand it. I mean, you're just a coach. All that. And I bought in. I can't believe that I bought in. But the bottom line is people are doing that every day. This is too complicated. It's too fancy. You don't get this. And the bottom line is they tell you got the wrong coach. You will tell me what you're buying with me or you ain't buying it. And that's the difference. I want you to use this for more things than you ever dreamed of. And you can be the bank. Now, I'm not telling you to start a bank, but the process is, yes, I am. Have you ever noticed how profitable the banks are? Have you realized that the last 10 years, even though we're in the lowest interest environment on the planet and banks set records, is it from those 0% car loans or 2% mortgages? I don't think so. It's not rate of return, but yet we're told that every day. You got to get a great rate of return. You got to get a great rate. No, it's not rate of return. It's volume of interest. And if you understand that lesson, I don't care what. Okay, so let's back up for a minute. The average guy that I talk to is the blue collar guy. Okay, I don't talk to many millionaires, especially when I started. It was none. All right, because they were all 20-year-old kids trying to get out of student loan debt. But the bottom line is you can't build wealth when 35% of your budget's going out the back door to somebody else. You can't do it. There's not enough money left to live on and to get the things done that you got to do, let alone if you throw a house, a baby, those types of things into the equation. Now, all of a sudden, you're questioning life. And the bottom line is, if you'll just take over the banking process in your life, you've got an answer. It may not happen as fast as you want it. It didn't. Okay. For most people, because they think it's some magic stick or some magic bull. It's not. It's not. But if you'll have the discipline to hang on to this thing for 7 years, it will change your life.
Man, Doug, we are.
Can you tell I believe in this?
Right there. No, I actually love that last part. I'm like, I feel like I'm in the locker room right now. Like, you got that like speech for everybody. It's freaking awesome. Yeah. And I really want to segue into the last part of the show.
Sure.
And just squeeze out a last little bit of details from you. And I think for our listeners, one of the biggest things that they really like to know is, are there any, books, people, podcasts, websites, anything that they can go and, learn more about this stuff, about infinite banking, about these whole life policies that you would recommend? We definitely know Nelson Nash. They should go and check out him for sure. But are there any other people you recommend, books you recommend for them to get a better understanding of this whole process?
Yeah, if you will go to peacockwealthgroup.com, you'll see 2 books. One is a green book called Be a Bank. And yes, that's my book. So yes, this is a shameless plug.
Oh, we love it. I'm gonna have to go get this book.
Okay. And it's very inexpensive. Okay. I guarantee you there are English teachers cringing across the planet right now. You didn't write a book. Oh my God. Anyway, it is written for football coaches and guys who are out here serving every day. It's not written for anybody but all the concepts work. Okay. There's actually one there for free for chiropractors. And it's called Adjusted, believe it or not, because it does take some adjusting, and it's absolutely free. So you can download a copy right there. You want to see what this is all about? Just every time it says chiropractor, just put your profession in there. Because there's nothing special about being a chiropractor. I just love what they do. Saved me from having back surgery in the early 80s, and I wanted to pay it back. And now I love them for what they do and what they, you speak about bringing value to people. Again, take some discipline. You got to learn, there's a little education to it. But guys, it's not what you can do it. A high school football coach can do this. You can too. I promise. It's not.
I love it.
It's not difficult. But those are 2 easy ones to get a hold of. I will tell you, I have never met so many crooked son of a guns in my life as I have in this industry. Okay. And they will steal from you in a heartbeat. If they mention rate of return, run. Wrong coach. Okay. I'll just tell you, call me. Use the number on the website, call me. I promise you, I'm not going to sell you, but I will give you some options that you didn't know you had.
Doug, we love it. So you said peacockwealth.com is where everybody should go?
Peacock Wealth Group.
peacockwealthgroup.com. For all you listeners out there that are interested in learning more about this, to getting a quote for a policy, go download the book. I know I'm going to be definitely buying the book, Be Your Own Bank.
Patrick is going to be a chiropractor for the night, and
I will be a chiropractor for the night, because this is extremely interesting to me, and I want to learn. I want to learn more about how I can utilize this for myself, for my business.
Yeah. So does it matter? Let me ask you something. When a bank starts, does it really matter how big it is when it starts?
No.
Same holds true with y'all. Any of us. I promise you, I never funded my first policy with enough money, because that's absurd amount of money to be giving for an insurance. Are you kidding me? Because at that point, my mindset was, this is an insurance premium. I've got to pay this bill. In about 3.5 years, I realized this isn't an insurance bill. This is a doggone warehouse capitalization project. And now it's just rolling money. And now all of a sudden I keep hitting the MEC limit. All right. So I had to have another one. And, so truthfully, you guys, you can own as many of these as the insurance company will insure people. I will tell you, we have run people out of no, we're not going to write anymore on him. Okay. I'm not sure his life is worth $27 million when he dies. And they're very, very good at that. Okay. The actuaries for an insurance company they can tell you exactly how many 65-year-olds are going to die today. They just don't know which ones, but they know the number, and that's what they run their numbers on. So the bottom line is, if you live a long time, you can't stop this thing from growing. If you die early, there is a huge death benefit coming on this thing that continues to grow with the cash value. Every time the cash value grows, guess what the death benefit does? It has to grow bigger, or it wouldn't be called an insurance policy. If it's not an insurance policy, it loses all of its tax favorability. Got it?
Well, Doug, we love it. Coach Peacock, we are very pleased, very happy, and very appreciative that you joined us on the podcast. For everyone out there, if you like content like this, we switched it up a little bit for you guys. We're trying to bring you new, exciting things that are going to educate, motivate, and inspire you to go out, reach financial freedom, reach financial independence, reach out and go take care and achieve your goals. So if you like this podcast, leave us a review. If you hated this podcast, send us a DM, because we don't want that review. But we'll check you guys the next time. Thank you so much. See ya.
See you guys.
Thank you for listening to the Real FI podcast, where you learn from the investors that have lived the hard lessons for you. To connect with us during your pursuit of financial independence, be sure to join our community by following us on Instagram or emailing us at info@therealfi.com. If this content made you financially, mentally, physically, or spiritually richer, please make sure to leave us a positive review on your preferred content platform. Cheers to kicking the 9 to 5.